What if I told you that $20, just $20, invested in the right company at the right time could have turned into over $1 million today? It's not a fantasy. It's not a scam pitch. It actually happened, multiple times, to ordinary people who had no idea what they were sitting on. Today, I'm going to show you the real stocks that did this, the exact traits they all shared before they exploded, and the honest truth about why spotting the next one is harder than the gurus want you to believe. Stick around, because by the end of this video, you'll have an actual checklist you can use. Section 1. The myth that's keeping you broke. Most people believe investing only works if you already have a lot of money. That belief is why so many Americans sit on the sidelines for years, waiting until they feel rich enough to start. But history tells a different story. Some of the biggest fortunes ever built in the stock market didn't start with a huge check. They started with a small amount of money in a company nobody was paying attention to yet. The catch: most people who bought those stocks early didn't get rich. Only a small number held on long enough and understood what they actually owned. That difference, patience and understanding, is what separates a missed opportunity from a life-changing one. So let's look at the real examples. Section 2. The case studies. Amazon. In 1997, Amazon went public at $18 a share. Adjusted for stock splits over the years, an early investor's cost basis works out to a fraction of $1 per share. Someone who put in a few $100s and simply never sold would be sitting on a stake, worth well into 6 or 7 figures today. Monster Beverage. Back in the mid-1990s, this company wasn't even in the energy drink business. It was a small, obscure beverage maker trading for pennies. Over the next 2 decades, it became one of the best-performing stocks in the history of the entire market, turning a tiny stake into a fortune for anyone who held on. Apple. In the early 2000s, before the iPod, before the iPhone, Apple was considered a struggling computer company that Wall Street had mostly given up on. Shares traded in the low single digits. 2 decades later, that same position, untouched, would be worth hundreds of times the original investment. Netflix. When it IPO'd in 2002, Netflix was a mail-order DVD company competing against Blockbuster, a giant that seemed unbeatable at the time. Shares started around $15. Investors who held through every pivot, DVDs streaming, original content, saw returns most people only dream about. 4 completely different industries. 4 companies that looked unremarkable, risky, or even a little ridiculous at the time. And 4 investors who held on made extraordinary money. Section 3. The honest warning. Now here's the part most finance videos conveniently leave out. For every Amazon, there were dozens of other cheap, obscure stocks from that same era that went to zero. Companies with exciting stories, passionate believers, and total collapse. This is called survivorship bias. We only hear about the winners because the losers quietly disappeared. If you'd spread a small amount of money across 20 random $1 stocks in 1997, you likely would have lost money overall, even with an Amazon-like winner mixed in. So this isn't about randomly buying cheap stocks and hoping. It's about understanding what actually separated the winners from the companies that vanished. And that comes down to a specific set of traits. Section 4. The checklist. What the winners had in common. 1. A massive, expanding market. Amazon wasn't just selling books. It was building the infrastructure for all of online retail. Apple wasn't just making computers. It was betting on personal technology becoming essential to daily life. The market these companies were chasing was enormous, even if the company itself was tiny. 2. A founder obsessed with the long game. Jeff Bezos famously reinvested profits back into the business for years instead of chasing short-term earnings. That kind of founder-led long-horizon thinking shows up again and again in companies that eventually became giants. 3. A product people didn't just like, they needed. Monster Beverage tapped into a shift in how people wanted to consume caffeine and energy. Netflix solved a real annoyance: late fees and limited selection. The winners solved a real growing problem, not a nice to have. 4. A balance sheet that could survive hard times. Every one of these companies went through periods where the stock dropped 50% or more. Amazon lost over 90% of its value in the dot-com crash. The companies that survived had enough cash and low enough debt to weather the storm instead of getting wiped out. 5. Insiders who bought instead of sold. When founders and executives are buying shares with their own money, not just holding options, it's a signal they genuinely believe in where the company is headed. None of these traits guarantee a stock will become the next Amazon, but their absence is often a warning sign, and their presence is what every one of these historical winners had before anyone else was paying attention. Section 5. How to actually apply this. You don't need to predict the next Amazon perfectly. You need a process. Start by looking at small or mid-sized companies in industries that are clearly growing, not shrinking. Read a few years of their financial statements. You're checking for manageable debt and consistent revenue growth, not perfection. Look at who's running the company, and whether leadership is investing their own money alongside yours. And most importantly, never put money into a single speculative stock that you can't afford to lose completely. Even with a perfect checklist, most small companies don't become the next Amazon. The goal is to stack the odds in your favor, not to bet the rent money on a hunch. The people who turned small investments into millions weren't smarter than everyone else. They weren't luckier either. Not entirely. They found companies solving real problems in growing markets. They understood what they owned, and most importantly, they held on through the scary parts. That process is repeatable. The specific stock isn't the point. The checklist is. If you want the next video where I run today's market through this exact checklist and show you which companies actually pass the test, hit subscribe, because that's exactly what's coming next. I'll see you in the next one.